Digest of the biggest market stories from the past week. Join host Anna Sarin and financial expert Bruce Campbell as they go beyond the headlines to deliver cutting-edge insights into news that move the market. Proudly presented by the Canadian Securities Exchange.
Hey everybody, it's James Black here with the Canadian Securities Exchange, and I'm filling in for Anna Sarin, who is on a special assignment. She's in Australia. So today it's me and with my dutiful host, Mr. Bruce Campbell, StoneCastle Investment Management. Bruce, how's it going?
Good. Yeah. How come we didn't get anybody to go on assignment?
Well, there's only so much cheddar to go around for these trips. And, if you ever looked at a business class flight to Australia, it is not cheap. So we've sent her on a special mission. She'll come back hopefully in 2 weeks. Hopefully she comes back. That's probably the biggest concern I have. Maybe she'll like it so much she'll just stay
there.
But
yeah.
Until then, the markets do keep moving. Things still happen. And today we're going to break down some of the bigger stories here in the market. Jobs will be our first topic of discussion. After that, we'll talk about Justin Trudeau's 2% buyback tax. We're going to talk about that a bit more. Year of interest rate hikes. We haven't gone through many shows without talking about interest rates. And unfortunately or fortunately, same case applies today. Seasonality, everyone's favorite topic, especially speciality of yourself and Jordan there at StoneCastle. And then Diddy does it again. I'll leave that one hanging for everyone. All right, so let's get right into it. Jobs. The Canadian economy added 180,000 positions in October in a blowout jobs report. So Statistics Canada reported on this and said this Friday, today, the unemployment rate for last month held steady at 5.2% as more Canadians look for work. So it hasn't changed. It's 5.2%. And meanwhile, our friends in the U.S., white-hot labor market, it's showing signs of cooling, with the Labor Department reporting this Friday, today, a slower pace of hiring and higher unemployment. So employers added about 261,000 jobs in October, and the unemployment rate actually rose to 3.7% from 3.5% in September. Please help us make sense of this, Bruce. What is going on here in the job market?
Well, I mean, there's lots going on. And I mean, this is the crazy dynamic of the market right now is that, the market was actually looking for worse numbers than what we were expecting. And if that had been the case, then I think the markets would have been up strong. They started up strong and then they kind of sold off just because, that's one of the factors of inflation and one of the factors that, they're trying to control. And so, we continue to see very strong labor markets, both in Canada and the US. The Canadian numbers tend to be a lot more lumpy than the US. So we'll have a month where the numbers are really high and then the next one where they're not as high. Whereas in the US, they tend to be a little bit more stable. But some of the interesting trends that are starting to come back here is that, we're approaching in some of the sectors the same type of labor rates that we saw as far as the number of people in those sectors from back before COVID. So leisure and hospitality is one that's, kind of right up there. Construction, I believe the numbers are actually higher than what they were pre-COVID. So, one of the challenges that we've been hearing, especially over the last year is just how many people or how many companies are looking for people to work for them. And I think that's now starting to be filled up. So, it'll be interesting to see where things go in the next few months.
Right. And, just going to the whole impact of inflation and everything else, the US and Canada seem to be playing off each other quite a bit. And the other story that we had to follow this week was the 2% buyback tax. So Prime Minister Justin Trudeau, his government took steps to level the corporate playing field with the US yesterday on Thursday, announcing a 2% tax on share buybacks. Now, just to explain, the buyback tax will be imposed on the net value of all types of share repurchases by public corporations in Canada. It is double the size of the 1% excise tax on repurchases that was signed into law by U.S. President Joe Biden as part of the Inflation Reduction Act unveiled in August. So if I can ask you, well, why we're implementing this in Canada, why 2%, and what really precipitated this? Can you explain, going back to the banks and their ability to repurchase, why we're now looking at this buyback and what it's meant to do?
Well, you've seen, the trend over the last decade has been a number of companies are all headed for the buybacks. And, it's a fairly significant inflow of capital into the public markets as these companies buy back their shares. And I think that politicians have realized this and said, oh, this is an easy way to tax and pay back for all that money that we spent during COVID. And so I think that they've, decided to do that. That at first, glance, like 2%, you say, oh, well, that's not that big, but it is a fairly significant number, but probably not one that, affects a board of governors or board of directors as far as how they would make that decision is whether or not they buy back or not. But maybe that pushes more people to pay dividends, which ultimately gets probably taxed at a higher rate than the share buyback does.
Right. And so I just have this stat here. Canada's 6 largest banks have spent about a Canadian 9.76 billion buying back shares since the Office of the Superintendent of Financial Institutions, OSFI, lifted its restriction on the practice a year ago. So that's a good chunk of change, 10 billion times, 2%. That's a bit of money in the register, I guess, of the Canadian government. Yeah. So good for them if they can get it, I guess. But yes, obviously they want to see the money going back into economic development, hiring, even though there's no one to hire and things like that. So, and I say that jokingly, obviously there's people to hire, but I don't know. Okay, let's move on. So the year of the interest rate hike. So we have not been able to cover an episode of this show for months now without talking about interest rates. So on Wednesday, the Federal Reserve announced a 75 basis point increase. The market reacted. We have charts. Walk us through what happened, Bruce, and where it's taking us.
I mean, everyone's been waiting for this number for weeks here now to see what was going to happen. And there's been lots of speculation on whether or not they would, move 75 basis points or 50 basis points or, 1 full percent based on sort of the inflation number. And they did exactly what we expected. So they raised that interest rate by 75 basis points. Initially, the reaction of the market was quite interesting because if you look at this chart here first, this is kind of more interesting, is the fact that you go back to a year ago, and, interest rates on the 2-year bond were at 0.4%, and now they're, at 4.7%. So you can see that's, close to 1,000% increase over, the last year. Historically, we've never really seen anything quite like that as they've raised interest rates up. And so that's what we've seen with the interest rates. What we've seen with the market was the next chart we look at is an intraday chart of the S&P 500, and you can see the market kind of had this level that it traded at for the first little while, and then you see that big jump up, and the initial jump up, that was when they made the announcement that they're going to have the 75 basis point increase, and the market, I guess, kind of cheered at the fact that in the prepared notes that they released, they talked about the fact that they might moderate down the road. When the press conference started, it was a whole nother story. And Jerome Powell spoke very firmly about the fact that they were not done increasing interest rates. Perhaps they didn't increase at the same pace, but the terminal rate, which is the kind of rate that they would eventually want to get to, was continuing to go up. The market did not like that. And you can see, kind of the back half of this chart looks like a ski slope. It basically goes, straight down with lots of mungles and bumps. So it hasn't been pretty, as we've seen, through a lot of this year in the markets.
Right. Do you think there'll be some curbing of interest rate hikes or, any sort of action or inaction from the federal bodies to slow this, or are we looking at more hikes early next year?
Well, there's another Fed meeting in December that the expectation right now is between 50 and 75 basis points. So I think we would see that. Interestingly enough, I saw a chart this week. We don't have it here, but I did see it. And it was talking about some of the smaller central banks around the world, and that they've actually started to slow the rate of their increases, which in the past, they've actually led the Fed. So I suspect that we're going to see that at some point in time. We really need to see that inflation data come down. And so when that next set of inflation data comes out, it'll be really interesting to see what happens. And if, it starts to moderate a bit, then, maybe the Fed says, okay, we've seen a little bit of data. We're not going to lower rates, but maybe we just put ourselves on hold for a little bit, or we, increase less than we had initially expected.
Yeah, that's a nice way of saying you're not quite sure, but we're going to find out soon enough. It's a big carrot, I guess, driving the whole market, and we don't really know where it's taking us quite yet. Okay, well, let's talk about seasonality. It's November. Now, I'm going to screw this up. It is the end of daylight savings time this weekend.
That's right.
So the clocks fall back an hour. So,
yeah.
And I know there's lots of people trying to undo this practice, but regardless, it's still a reality that we have to deal with. So hopefully you wake up on the right time on Sunday. Talk to us about seasonality. Now that we're in November, not only are the leaves falling off the trees and things are changing, maybe about to see some snow. What is it doing to the markets? What's happening?
Well, if you look at seasonality for the markets, they tend to be the strongest for the 6-month period, really from the beginning of November through to May. And what we've seen, kind of this year, you certainly have seen, not a lot of seasonality follow the same pattern as normal. But we're also looking at the fact that we're in a midterm election year. And so one of the charts that we have here is looking at seasonality during midterm election years. And you can see that, through the first half of the year, it tends to be fairly weak. And then the last 3 months, it tends to be a little bit stronger. And that's exactly what we saw. We saw a rebound in October. So far, November's bounced around a bit. It's a little too early to determine, but seasonality is certainly on our side. And then the next chart that we have up there is just looking at the.
Sorry, not to confuse our viewers. This was the chart you were just referencing, correct?
Yeah, exactly.
Okay.
Yeah. So as you can see there, it kind of bounces around, and typically the returns are negative up until the point that you get to that, October, November, December, and then they produce positive returns in that midterm election year. And the midterm election year also tends to be one of the weaker years for the markets. The good news is the fourth or the third year of the presidential term, which is next year, starts kind of almost immediately here, is the strongest. And you can see that from this chart that in year 3, historically, the returns have been the highest. So seasonality is working on our side, and the presidential election cycle is working on our side. There's a lot bigger things going on beyond this, and the market doesn't have to follow this. But it certainly is always interesting to see how the cycles play out, even though the news is different and the events are different, that the cycle often plays out exactly as you would expect.
Good advice there. Yeah, no, it's there is some predictability in the market, if you can say that. So maybe just to take it a little further, midterm elections are coming up, and we do know that there could be some impact in our favorite sector, the cannabis sector. So maybe next week we'll talk a bit more about that as we get closer and have more information to digest. But today's big story was obviously Diddy, so otherwise known as Puff Daddy back in the day. He has bought, or is going to be the proud owner of, some new cannabis assets. So let me just read this one off for you. Sean Diddy Combs to acquire cannabis businesses for up to $185 million. So I'm not sure how much he's committed to actually purchasing, but Mr. Combs is acquiring the cannabis operations from Cresco Labs and Columbia Care, which are divesting assets as part of their merger. So these are actually, this is a sideways door into CSE issuer news today. So both these companies obviously listed on the Canadian Securities Exchange, 2 of the bigger MSOs in Canada earlier this year. Now one entity, and obviously having to divest some of their assets, which the operations, including those in New York, Massachusetts, and Illinois. So there is some more subtext to this. It'll be one of the biggest, if not the biggest, Black-owned business in the cannabis sector in the U.S. Do you see any other reverberations or fall off from this, or is this more of just something that these companies had to do to make sure that their merger was actually viable?
Well, I mean, that's the headline that the market's looking at. I mean, it's great when you see a celebrity who's got, certainly name and celebrity status coming into the sector. That always helps. But, what the market's looking at and kind of cheering today with with both of those stocks and the MSO up is the fact that, the market believes now that they're going to complete their deal. There's been a couple of deals so far in the cannabis sector that haven't gone through this year that are, significant deals. And so, the market's looking at this saying, okay, well, if they're at the point where they're talking about divesting assets, then, that has to be for a competition purpose. And that means that the merger is still proceeding. So market likes that. And those stocks are up, and the MSO index of a lot of the US multi-state operators is up as well.
Wonderful. Yeah, no, and I'm a fan of Mr. Combs' music, obviously from my era in the 90s. Some of the biggest hits of the day. So I'm glad to see that he's still relevant and being an entrepreneur and doing all these exciting things in the sector. More to come, I'm sure. We'll leave it at that for the week, though. So looking ahead to next week, what's on your radar, and what should we be thinking about as investors?
Well, the biggest release is going to be the CPI, US CPI data that comes out. So everyone's going to be watching to see what happened in October. Did things slow down? Did they continue to accelerate? And that'll be something that moves the market significantly. If it's lower than expected, the market's probably going to rally. If it's as expected or higher, then the market's going to sell off. So it's really going to come down to the numbers.
Always comes down to the numbers. All right, Bruce. I'm James. Really appreciate you joining me today, everyone. Me and my mustache. I'm going to put actually some details below in today's description. We are raising awareness and money for Movember. So this isn't just a vanity mustache. This actually has a purpose. And Bruce, I see you haven't started to join me yet, but I will recruit you. And we will be back next week. I don't believe Anna will be back in time from her journey. So I'll be back here with you or Jordan to again talk about the markets, so CPI numbers and many of the other things and unexpected things I'm sure that will happen. So until then, have a wonderful weekend. Talk soon, and thanks for watching.
Yeah, have a great weekend.
Cheers.